So this next chart, let's bring that up. This is just a historical look. Perhaps we can move our little thumbnails there so that we can look at how gold performs versus the S&P in a recession. So this historical chart goes back to every major recession in the US, how long it was, what the percentage change in the nominal price of gold was, and the nominal change in the price of the S&P. And by and large, not every time, but by and large, gold will greatly outperform the stock market during a recession. And honestly, I think we're seeing that now. Gold is already higher than the S&P in the last 12 months.
Right.
For gold to be outperforming the S&P before a technical recession is confirmed is exactly what happened in 2007. And if we want to look at the 2007-2008 recession and what happened there, well, you had a massive outperformance in gold versus the actual return that you saw over that time span in the S&P. So I think we're gearing up for something very similar, although add to that all the various geopolitical tensions that we're seeing. And like you talked with Jake just a few minutes ago with NATO and all that other stuff, that just adds more fuel to the fire for the price of gold, which is, of course, exactly what we're experiencing right now.
Yeah. That 1973 number is pretty phenomenal. 87% increase in price of gold. Exactly. It feels very similar to that, potential time period.
Yeah, that was a stagflationary period, which honestly is quite likely what we're going to expect here. Now, what stagflation is for our audience members that aren't familiar is when you have a stagnating and contracting economy, you're in a recession, but the price of all the goods and all the necessities, energy, fundamentals for every household, they continue to go up. So when you have a combination of a recession and high inflation, you get stagflation. And that's exactly when the metals perform best. That's actually where we are right now. If I were to make a prediction, we are going to, especially with tariffs and everything else going on, we're going to continue to see high inflation while entering a recession. We haven't been in stagflation since the 70s, which literally was the largest precious metals bull market ever. And I think we're going to see that probably outdone over the next 5 to 10 years.
Yeah, great chart.
So I've got I just want to kind of touch on the stock market, Colin, if you don't mind.
Yeah.
I think everyone, that has yet to roll over a 401k or an IRA is largely in a 70-30 stock to bond type of allocation. So we know that households and boomers in particular as a demographic are more exposed to stocks now than they ever have been. And that's at a time when the stock market is still relatively high, very overvalued on a technical and historical basis. So we've talked a lot about the Mag 7, the big 7 stocks that have essentially carried the US indices for the last 2 years. This is them just over the last couple of weeks now correcting and breaking support. We've talked about technicals. That bottom line is like a floor and that top line is like a ceiling. And we've been more or less respecting the boundaries of that particular formation, but we've now broken down below there, which means we can actually see new lows. And my expectation is that we very well could with all the various things going on in the world right now. So just to put some numbers to paper, we have lost $3.3 trillion of market cap in US stock indices over the last 10 days. So that is a loss of $330 billion every day for the last trading days.
Wow.
10 trading days, pardon me.
Yeah, unbelievable.
So this stock market sentiment indicator correctly shows that we've now entered the extreme fear territory. So we could see a continuation of this trend for days, weeks, months. It really just depends on how bad it gets. So I think this is a relevant indicator just for people to know where we're at on the spectrum. We've talked about the importance, Colin, of NVIDIA with respect to the Mag 7, and it really has been a high flyer for the last couple of years. We now have NVIDIA just yesterday closing below the low that was seen in at the end of January when this whole DeepSeek competitor had broken out and come into the news. And so that was a real disruptor to the dominance that NVIDIA has over the AI space. It had a 17% sell off in 2 days.
Yep.
But we are now actually below those lows, which is a technical floor. If we are making lower lows now, moving forward, we could be in a bear market territory. Let's have a look at another important chart. This is the Nasdaq. Let's just throw our thumbnail screens to the other side if we can. Showing you again that band that I've drawn across there acted as a bit of a ceiling going into August, which was actually the last time we had a significant correction, but we have since really the August lows been able to make higher highs above there. So the Nasdaq has been making pretty much new all-time highs since, let's say, end of December. But we now have broken below that key channel, which again, like with the NVIDIA chart, means we're making lower lows and could actually be the start of a corrective phase for the indices. Now, this next chart, very, very important. It seems a little bit complicated, but I'm just going to distill it here in a couple of key points. This is the price of gold versus the Nasdaq, and it's a 30-year chart. So what we can see is on the far left, as the price of the Nasdaq went up and the price of gold went down, you get that downward movement in the ratio chart. So that means that the price of the Nasdaq is greatly beating the price appreciation of gold. But you can't see it, it's just behind my screen here. In 2001, what happened? The dot-com bubble. Dot-com bubble marked a 10-year period where gold beat the Nasdaq for 10 years. The Nasdaq actually went nowhere during that period, and we had a price increase in an ounce of gold from roughly $200 an ounce to $1,900 an ounce. So,
and we cut rates then too,
exactly.
right? So that's what we're trying to do again now, right? And we're trying to cut rates again, because I was talking to somebody about this. I truly believe that we've set the real estate prices were set at a level for over 20 years that were not real prices. And so a lot of this is the market from 2001 to 2011. What the market is really doing is saying, yeah, I see this real estate thing happening, but really I believe in physical investments. I believe in gold. That's what's really the real values there. And those things will be consistent over time.
Absolutely.
And now we have to get back to a middle ground. I don't think interest rates go back to 3% anytime soon, but we have to find that middle ground so that people can just stay in their property, stay in their home. Otherwise the banks fall apart. I mean, the whole thing falls apart, right? I mean, I think that was a big lesson that hopefully we've learned for the past 20 years, that it just created an unbelievable real estate market that actually made no sense.
Yeah. But so the important part about this particular chart is that it illustrates that we're coming into a massive, likely decade or more long period where once the price of gold breaks out versus the Nasdaq, and we're right on that cusp, kind of on the right side of that chart, literally we're a couple points down in the Nasdaq and a couple points up in the gold price from breaking out, which will mark the entrance or the beginning of a new gold era where gold outperforms the Nasdaq, which is the tech stock index, for a period of 10 to 15 years. So like it did from 2001 to 2011, gold outperformed the Nasdaq. We have now a period that we're entering that will be exactly the same. So for me, this is a very exciting generational opportunity. Gold's at all-time highs, or very close to, but it's nothing compared to where we're going in the next, like I said, 5, 10, 15 years. The physical metals delivery is just ongoing. We have record amounts of gold coming into the COMEX. Again, we'd speculated, is this the Fed buying? Is it the Treasury buying? Are they refilling Fort Knox prior to the audit, which is going to kick off at some point later this month? I think it's the 19th of March. That happens to also be the next Fed rate cut decision day.
Wow.
So
big day. That's
big day for our business. Absolutely. And a lot of anticipation between now and then.
Yeah.
So gold just, it's insatiable appetite here for whoever it is. We still don't know exactly. But silver, I want to, it's not been part of the conversation as much. Silver, I want to show this next chart that shows that we have record amounts of silver flying out of the LBMA. We're at the lowest levels ever for what remains in that commodity exchange for physical metal. So it's not just gold. Silver is as well getting gobbled up by, again, high net worth investors, smart money, institutional money.
So these investors are taking physical possession.
They are. They absolutely are. They don't want paper. They don't want to hold the futures contracts. They want physical metal.
Mm-hmm. Smart.
Yeah. Yeah. So let's just jump ahead here. So, we've just speculated who's doing the buying, right? And why. It's really significant. I think, and I actually had these points on my chart from the last time that we spoke, Colin. The only real reasons that the US would have for removing physical metals on this scale would be a number of things, but they're all big. So it's either the US thinks that Europe is about to get way less safe. Now, I had that written exactly the same way. This was prior to the Zelensky, NATO, Russia-Ukraine escalation. So that is definitely something. They think that Europe's going into war. World War III could be kicking off. And they just want to get all the metal that they can here. But also, you see this type of repatriation of gold prior to going into periods of major financial uncertainty. So it could also be that the US knows that they're going into recession. They may be, again, trying to cause a recession in the shorter term for political reasons, for strategic economic reasons too, get the 10-year yield down. But they could be doing it kind of for both of those. They think Europe's about to get less safe. War escalations could be around the corner. And we're coming into a period of financial instability. But it could also be some of the stuff we talked about where maybe they're reshoring gold reserves in Fort Knox prior to the audit. Maybe we're going to revalue gold to some astronomical number to help reduce our debt and improve our debt to GDP ratios. Maybe we're developing this gold-backed bond. But something I want to know, just as kind of an important point, is Nazi Germany, prior to them actually escalating invasions into Poland at the right before World War II, they repatriated a ton of their gold from the vaults in England. And so, if we think that's the direction that we're headed in, is World War III or some kind of major geopolitical conflict, it kind of lines up with us wanting to get our metal here on, home turf before any of this crazy stuff happens.
Yeah, it makes perfect sense. Yeah, you want to have all of your assets under your roof, right? I mean, you don't want to have it in another place. So it makes sense that everybody's trying to get everything closer to home. Everyone's getting prepared for, whatever could happen. Any of these scenarios.
Yeah, exactly. So when it comes to geopolitical risk, this is an interesting chart. This is a moving average of the indication. It's a moving average of essentially periods of risk. And so it's not quite up to date. This chart is actually from the September of 2024. But what it shows you is that we are, if we look at charts and kind of the way that they behave, if you want to look at the right side of that chart where I've got a little arrow drawn, is we are actually breaking out, and we will end up seeing a major spike in the geopolitical risk index, which I think just adds data support to this idea of us taking all the gold out of Europe, bringing it home before something bad happens. Now, what is that something bad? You've got a couple of various events kind of marked here to show you and explain what these spikes can be caused by. But we're coming into something, right? If we were to see an updated chart, and I think we probably will at the end of Q1, so probably sometime next month, is already a spiking chart, which means we're coming into this type of territory again, elevated risk for everybody in the world.
Yeah, that chart would be more accurate if you put Israel and then fighting everybody, which it feels like they're always they're fighting off countries on every border at some point.
Exactly. Yep. So then I have one other chart here just showing you the price of gold. Now this is dated as well. It's only I found it. This is shows you what happens to the price of gold after a major conflict kicks off. So at the exception of the Gulf War, which is, late 80s, early 90s, anytime there is a major war escalation anywhere in the world, you end up with a rising gold price. Now, the actual price of gold, this shows it, down at around 1100 in 2015. We're already 3 times higher than that. So the price of gold on this, before any actual major escalations have started, the price of gold is already off this chart, right? So that just, again, backs up even more the fact that we're coming into an era where hard assets, physical metals, with no counterparty risk, no sanction risk, every country, every high net worth investor, they're all prioritizing physical metals for good reason. And honestly, retail investors need to, it's kind of like, watch what I do, not what I say. They still probably want people to believe that there's no utility in holding gold for a large part of your portfolio. But obviously the data and history show you what happens when we kind of come into the territory that we're firmly in right now.
Michael, you're talking to people every day, clients of ours. Are these the risks that you lay out? Are these a lot of the risks that they feel? Is this why they're getting into physical gold and silver? What are people saying on the phones to you daily about this?
A lot of concern about the dollar, a lot of concern about the banks, a lot of concern about the stock market also nearing a corrective period or being at all-time highs. I would say that the dollar is probably a predominant risk.
Concern.
Yeah. And people wanting to hold an asset that's not dollar denominated, like physical gold and silver, can be sold or priced in any currency in the world. So by holding physical gold and silver, you've actually now, you're dollar neutral in that specific asset. So I would say that's top of mind. But honestly, there's a lot of speculation out there about what's going on with all this gold getting repatriated as well. And like I've noted, it could be because we're going into recession. It could be because something major on a war front is happening in Europe, and people sense it. I mean, I think people really, more than anything, Colin, just sense that something is off. And I have those feelings too.
Yeah.
So I'm constantly doing this research in order to kind of piece everything together in my mind so that I can actually kind of create the narrative and explain to clients exactly what it is that we're seeing and why gold and silver are a great way to protect yourself from wherever we're going. But people just sense that something is off.
Something's not going right. They understand, they feel it. And even though the CPI hasn't gone up to 8 or 9% like before, it still feels like things are getting more expensive. Doesn't feel like the job market's that great. So, and it's like my grandfather said, it's better to be a few days early than a few months late. And I think that's the preparation that people are doing right now. And what I've seen with clients that I've talked to is they love the safety of gold. They love the opportunity in silver. And I think that's what I've really seen. I obviously talk about it a lot in my book, is just this incredible opportunity, the super cycle opportunity. And silver still hasn't moved the way gold has moved. And people are surprised by that.
It's frustrating.
It's
frustrating for those who've owned it for years, including myself. Like I always say, I'm an investor first and a sales guy next. I've been buying for 8 or 9 years.
Right.
90% of my portfolio is in silver. I own a little bit of gold that I bought back when it was $1,500. But the opportunity is in silver. Silver will grossly outperform gold when we get to that time. Now, when will it be? I think it comes once we have a true rotation of capital, once the stock market correction is really underway. But we have to remember that gold and silver's kind of typical behavior in a precious metals bull cycle is fairly predictable, and gold always makes new highs first. It's the metal that leads the trend, and silver, if gold is like the kind of calm older brother, and it makes it sort of newer highs first, and it's chugging along, steadily but surely, and silver sort of the little sister that's kind of dragging way behind, and then kind of realizes that at one point, oh my gosh, my brother's gotten so far ahead of me. She's now going to have this kind of elastic slingshot move and get ahead of him in terms of a percentage appreciation, she always, without exception, silver always outperforms, but it's on what kind of time frame. And so I think we'll see 30 to 1 in the gold to silver ratio, which is the previous high from, or low technically in the chart, from 2011. So when 2008 hit and we had the global financial crisis,
right,
gold tripled in 3 years, which is fabulous. And I think that gold's probably on track to do something similar over the next 3 to 5.
right.
We could be looking at $8,000 or $10,000 an ounce gold by 2030. However, silver at $30 probably will get something closer to 200 or 300, and that's consistent with what happened after 08. Gold tripled, right, but silver went up 8.5 times.
Correct.
And so that gold to silver ratio from 2011 was a 30 to 1. We're right now at a 90 to 1.
Right. Right.
So the conversion strategy that I always ask my clients to consider is gold's great. You can't go wrong. You're never going to lose on an appropriate time frame. But with silver, you can either own 3 times more gold or make 3 times more money if we go from a 90 to 1
to a
30 to 1.
Absolutely. Yeah, it makes sense. I mean, listen, even if it goes 60 to 1, you're going to be happy there.
Absolutely. Absolutely. So I think in terms of, where we're at right now, this silver chart that's been up here for a couple minutes, I'm sorry I haven't spoken to it yet. This more or less kind of outlines what I think we're in for the next few months for silver. So we'll take a crack at that $35 mark, which was the high from October, right before the elections.
Yep.
And we might find some resistance there. Typically, when you get to a kind of an all-time high or a recent high, you're going to bop your head against that, like a bit of a ceiling. But I have no doubt that at some point over the next few months, we will go through that resistance at 35 into the high 30s and low 40s. And that's just for the spring. I think we could spend the summer consolidating there before we make a real run at breaking the actual all-time high of 50, which would probably be, in my opinion, sometime this fall.
Yeah. I mean, I've in doing this for so long, June, July sometimes can be sleepy.
Yep.
But I don't think this year we're going to see that same kind of sleepiness in the metals market. I think it's going to be pretty frothy this year.
2020 is a great example of that frothiness. So you're right. Seasonality for silver especially is, June, July.
Yeah.
Usually there's nothing going on. And last year was a good example. It went from $22 to $32, a 40% jump between March and May. So 2-month 40% return in silver.
Right.
But then it spent the summer months consolidating,
yeah,
going back to 28 before it ripped from 28 to 30, 35. So I think we could see a very busy year for us. Honestly, all this stuff is just fuel that's just being thrown on the fire. Fundamentally, the metals look great. Technically, the metals look great. Geopolitically, they look great. Again, watch what they do, not what they say. Every central bank is buying. Major stuff going on right now, Colin, that just all roads lead to gold and silver.
Absolutely. Yeah. And for anybody, watching, if it's your first time, you want to learn, talk to Micah, give us a call at Noble Gold Investments. You can talk to Micah, learn about precious metals. Obviously, we got into some depth, but everyone's situation is different. So you want to talk to him and
absolutely,
he can walk you through the process. Someone that's been buying a lot of silver, owns gold, can go through our products, pricing, how the IRA works. But I think it's quite a unique time in the market. So again, Micah, thank you so much as
pleasure,
always.
man.
So
Absolutely.
interesting.
Anytime.